Albert Einstein once said that life is like riding a bicycle. To keep your balance, you've got to keep moving. Let's talk about 2022. So today we're going to touch on some good things that are happening and some not so good things that are happening. And it really has not been a great start to the year for stocks or for bonds. But like Einstein told us, to keep our balance, we've got to keep moving forward. So we're going to start today with maybe the not so good stuff. Stocks are down about 10% to start off the year. Bonds are also down 10% as of the time we're recording this. And this is one of the worst starts we've seen to a year ever for a diversified portfolio. We do think it's going to come back, by the way, but we'll get to that. So what are the concerns out there? We've got inflation, we've got an economy that's slowing down, we've got geopolitical concerns, labor issues, and all these things are well known, right? But really, let's not forget about soaring interest rates, by the way, that have just wreaked havoc on the bond market as well. So this is a midterm year, and every year is different. Every midterm is different. But in a midterm year, what we typically see is the market hits its bottom maybe later in the year, like around August, before the election. So that's not so great news. There's a chance the bottom could still be ahead. But the good news is, coming out of that, the 12 months following that bottom, the market averages a return of over 30%. So again, we don't have a crystal ball, but that's why it makes sense sometimes to look backwards to give us a little perspective. Okay, how about some good news? So we're always going to start with earnings. Earnings season off and running yet again, and we're watching corporate America increase their expectations going forward. Companies are making more money than they ever have before. And at the bottom, bottom line, that is what we're invested in. The consumer makes up about 70% of the economy, so we always have our eye on the consumer. In the US, we've accumulated over $4 trillion between checking and savings accounts. So people have money, they are spending, and we expect some of the service industries, hospitality and leisure, travel, we expect those to pick up and also do very well this summer. So we've got corporations in really good shape, we've got consumers in really good shape, and though we took a step backwards with GDP in the first quarter, we do expect a positive number and a strong rebound in quarter two to avoid a recession for the year. Another piece of good news is, this is a contrarian take, but it's a pretty accurate one. Everyone is bearish. So if you're looking at some of these sentiment polls that we see out there, the retail investor is just not very optimistic right now. And yeah, I say that's good news because, no offense, the retail investor gets it wrong more often than not. So let's think back how bearish everyone was, this time 2 years ago when we were in the midst of the pandemic, and look what the market did from there. In terms of inflation, so we are at historically high levels currently, but we do feel confident that the rate of inflation is likely to peak soon if it hasn't already. And we're watching it happen right before our eyes. So used car prices have come down significantly. Shipping costs have come down. Hopefully those things reflect a little bit of relief in some of these transitory supply chain issues that we're seeing. But if that does come to fruition, if we do see inflation roll over later in the year, which then allows the Fed to maybe take their foot off the gas with some of these rate hikes, combine that with a pop from the midterms, and then we continue to see really strong earnings growth, we still have a lot of good reasons to be optimistic, and we are confident we'll see a positive number here in 2022. But as always, we are here for you. So that's especially the case when so much is going on and when you've got questions. So we'd love to hear from you if you've got concerns or just want to talk. Thanks so much for watching.